Welcome back to the channel, folks. Your trusted source for all things economic and financial, Boss Economics World is here, ready to break down another perplexing, yet critical aspect of current economic policy. Today, we're diving into the Federal Reserve's latest moves, exploring their intentions on what appears to be a slower pace of interest rate cuts, despite the mixed signals we're getting from the economy. You've probably heard the news already. Federal Reserve officials are likely to lower borrowing costs for a third straight meeting this week, yet the bigger surprise is that they're signaling fewer interest rate cuts next year than previously projected. Now hold on. You see that? This is where we start to question what on earth is going on with these policymakers. On one hand, some data is showing inflation is cooling. On the other hand, the economic resilience and the stubborn labor market has got the Fed thinking twice before slashing rates too much. Isn't that a contradiction we'd love an explanation for? But more on that later. Let's break this down for perspective. First up, let's get this straight. The Federal Reserve cutting rates is not exactly breaking news. The key issue here, ladies and gentlemen, is pace. A quarter percentage point cut is on the books, moving us to a federal funds rate range between 4.25% to 4.5%, which, by the way, is still pretty high compared to where they said they'd like it to be in the long run, around 2.9%. So why the cautious approach if the economy supposedly isn't in deep water? Is the Fed playing it too safe, or is there something even professionals might be missing? Well, Tim Dewey from SGH Macro Advisors explains it in more nuanced terms. The Fed wants to be cautious, especially as it gets closer to higher estimates of the neutral rate, which will neither stimulate nor slow down the economy. How do we interpret that? It's like walking on a tightrope. You can't balance too much in either direction, and when you're up this high, falling could really, and I mean really hurt. One of the core issues here is inflation. It hasn't been coming down as quickly as the Fed might have hoped. Even though their moves so far have slashed the rate, inflation is still above the 2% target, and we all know that in real-world terms, consumer prices are affecting everyone's wallets more than politicians or central bankers seem to realize. Your everyday guy buying groceries. Your local small business owner managing overly expensive supply chains. These aren't just small hiccups, these are big red flags simmering under the stats the Fed loves to tend to. But let's not forget, the labor market is staying hot, too hot, in fact. Does that sound familiar? Unemployment hasn't spiked as much as expected. There's this persistent mismatch between supply and demand for workers that's pushing wages up, egging on more inflation. Fed Chair Jerome Powell has mentioned on multiple occasions that too much strength in the labor market keeps wage inflation, and eventually price inflation, high. Higher wages might sound good for workers in the near term, but trust me, unchecked wage growth in an inflationary spiral is the calm before a very damaging storm. Now, you might ask, why all this sudden fuss about the neutral rate? Well, the recent stronger-than-expected data is making the Fed rethink where this elusive neutral rate actually is. The neutral rate is this fancy term the Fed uses to describe the rate at which monetary policy is not constraining or boosting the economy. Basically, it's the sweet spot. Now, SGH's Tim Dewey suggests that if the Fed is getting close to that neutral rate, currently higher than in past estimations, it might pump the brakes on those rate cuts to avoid going too far and unleashing more turbulence. The Fed doesn't want to overshoot, and, in classic bureaucratic fashion, they might choose to take this approach slowly. You know, like trying to turn a ship in a storm, only to realize the storm is both stronger than expected, thanks to inflation, and yet weaker in terms of expected damage from the labor market. It's all very disjointed, and ironically funny, if it weren't so serious. But look, it gets even murkier when it comes to considering President-elect Donald Trump's proposed policies. What do tariffs, possible trade wars, and so-called tough immigration measures mean amidst everything else? The Fed can't ignore the future impact of these policies on markets, yet until they see a more detailed blueprint, they're flying blind when it comes to including them in their forecasts. Sound messy? That's because it is. Welcome to the real world of global economic strategy, where everything is interconnected, but no one seems to have a clear answer. Now, let's talk real macroeconomics here. A hesitant Fed with fewer rate cuts doesn't just affect the American economy, this decision reverberates around the world. The Fed's cautious stance can squeeze emerging markets, where governments and businesses alike rely on relatively stable borrowing conditions. Higher U.S. interest rates pull money out of these economies like a vacuum. The result? Local currencies fall, dollar-denominated debts become unbearable, and you get a ripple effect that makes weak economies stagger. The European Central Bank, ECB, the Bank of Japan, BOJ, even the People's Bank of China, are all watching Fed actions like hawks, because what the Fed does with interest rates impacts global capital flows. And let's be honest here, none of these global players want another market blowout. Remember the debacle of the 2008 financial crisis? The world economy has built a very fragile recovery shell since then, and the last thing policymakers want is another recession brought about by global monetary misalignment. However, it seems like some people might just be betting on the idea that a recession could be less catastrophic than staying in this inflationary hot mess long term. If that's the gamble, then trust me, we'll see some serious capital flight in the coming months. The infamous dot plot. For those of you unfamiliar with the term, the dot plot is a visual representation of where Fed officials think interest rates will go in the future. It's a tool for transparency, but honestly, if you squint hard enough you could see it as Fed Jedi mind tricks on Wall Street. According to the latest remarks, the dot plot will probably show fewer cuts than the 3 predicted in September. What does this mean for investors? Well, right now, financial markets are yelling at the Fed, pleading for as many rate cuts as possible. But in return, they're receiving a cold, calculated answer, fewer cuts, and a much slower pace. What the markets may want, a quick return to low borrowing costs and a stock boom, doesn't seem to be what Powell and company have in mind. Wall Street might get restless, but the Fed is eyeing the longer-term risks. After underestimating inflation for so long, they are navigating through muddy waters, afraid of making the same mistake twice. So, what does this all mean for financial professionals and for those of you following this channel hoping to make sense of these policies? I certainly hope you aren't taking the passive, business-as-usual approach. First off, hedging is essential. With uncertainties so pronounced around rate cuts, everyone from bond traders to corporate treasurers should be preparing for currency volatility and sudden asset revaluations. Inflation makes cash flow projections trickier, and with the Fed holding rates higher for longer, borrowing costs remain less predictable. Moreover, staying diversified and leveraging international opportunities wisely should be a priority. High U.S. interest rates and a resilient dollar may sound good for the American investor in the short term, but savvy professionals should book exposures in safer, interest rate-sensitive markets like housing, essential commodities, or high-grade corporate bonds, anywhere you can lock in favorable returns when rates pivot back down. The timing of Fed policy decisions might seem slow and cumbersome, but understanding the nuances and the risks at play can help clear the fog. Rate cuts draw attention, no doubt, but the problem is how slowly or aggressively they will roll out. Stalling inflation, a hot job market, and undefined policies from the incoming administration are no trifling matters. These concoctions make it difficult to predict 2024's economy with exact clarity. Jerome Powell and the Fed's job isn't easy, and perhaps that's an understatement. In the meantime, it's wise not to bet too heavily on rapid normalization in monetary policy. Watch how the economic data unfolds, especially inflation and jobs reports, because the real-world economy often refutes econometrics. Will Powell face stronger critiques on Capitol Hill if inflation lingers into the next year? Will emerging markets handle the collateral damage of Fed policies excessively focused on domestic issues? Stay with us as we continue bringing you clear, no-nonsense breakdowns of these complex developments. Until next time folks, this is Boss reminding you once again, in the world of macroeconomics, nothing is as simple as it seems. Right now, we're playing it cautious, but behind the scenes, the ground is shifting beneath our feet.